Hello, welcome to this Ned Davis research video where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we'll be speaking with NDR's Chief Economist, Alejandra Grindal, about the potential for a global recession. Alejandra, are we on the verge of a global recession?
Thanks, Brian, for having me again. So the good news is not at this time. In fact, the global economic lull, where we still saw positive but just slower global growth in the second half of 2023, is actually starting to go away and get better. So, for example, one of the indicators we like to watch is the global composite PMI. This includes both the services and manufacturing sector. It actually rose for a third straight month in January and to an 8-month high. And as you can see on this chart, this is good news for stocks because accelerating global economic momentum, as shown by this PMI, has historically meant strong global equity market returns. The other part of good news is that it also puts the indicator even further away from what's historically been considered a recessionary threshold. So, again, minimal risk of recession. Also, our global recession probability model, this is one of our in-house models. It is designed to call OECD-defined global slowdowns. It actually recently updated for March, and you can see that in this chart. And you'll notice that slowdown risk not only remained low with a reading of 27%, but the odds have actually lessened for a second straight month.
But what about the recent job cut announcements in the United States, as well as Japan falling into recession?
Yeah, they both sound pretty bad, right? So first, just looking at the job cuts in the United States, according to Challenger Gray and Christmas, they actually give monthly data on announced job cuts. They found that they surged 136% in January to 80,307. So this was actually the second highest for the month of January since 2009. But one thing that's important to note is that this layoff data is actually non-seasonally adjusted. So it can be pretty volatile from month to month. So we like to focus on the 12-month average. And if you look at that, layoffs are not only below their historical average, but they actually fell to a 6-month low in January. Over the past 12 months, job cut announcements have been concentrated in the tech sector. And in fact, it's encompassed about a fifth of total layoffs. But if you compare it to other sectors, the tech sector saw a huge ramp up in hiring during the pandemic, which may have been excessive once the economy reopened. So this could be a little bit of payback. Economic conditions continue to be a major reason citing for job cuts. But if you look at other reasons, sometimes it's just, needs of individuals that's also been contributing to that. At the end of the day, the key factor to watch is the absorption of these job losses. So many of these tech jobs tend to be white collar jobs, suggesting that those who have been laid off could perhaps find another job easily. It's somewhat confirmed with the data because you'll find that people who have been laid off in higher paid sectors are just more likely to receive severance packages. And so this, in a way, helps explain why jobless claims remain at rock bottom levels, as these packages will often disqualify people from filing unemployment benefits or just, make it unnecessary to file the claim. They just don't want to go through the hassle. Brian, you also asked me about my views on Japan. So very much indeed, Japan's real GDP contracted an annualized 0.4% in Q4, and this follows a 1.1% decline in Q3. So just using the simple rule of 2 successive quarterly declines in real GDP, this latest data officially puts Japan in recession. Now, it's worth noting that Japan's economy actually contracts quite often. In fact, in 17 of the past 18 years, Japan's economy has contracted at least 1 quarter per year. Often they've contracted twice, but very often they skip a quarter, so they end up not falling into technical recession. And this pretty much stems from Japan's extremely low potential growth, which is just slightly above zero. This is due to weak demographic and productivity trends. And all in all, it just sort of makes it easier for the economy to go into negative territory.
So what are the key risks that you're following to determine whether the global economy is going to slip into recession?
Absolutely. We always have to be watching the risks, right? So the glass is looking increasingly fuller. I think I've sort of outlined that, at least from a global aggregate perspective. But of course, we need to be watching the downside risks. So the number one risk continues to be associated with monetary policy, right? And just the risks of whether we'll see cuts, the associated impact on inflation. We're also watching developments in China. Growth appears to have stabilized amid targeted support, but an unexpected sharp slowdown could have pretty negative global implications because it is typically the world's largest contributor to global growth. Now, the good news is you can actually see that the risk remains low if you look at our severe global recession watch report, which we show right here. And this report is designed to identify traditional global recessions. In those cases, you tend to see global growth below 2.5%, and you also tend to see the US in recession. So in other words, when the US has economic problems, it likes to spread it to the rest of the world. So good examples include the COVID pandemic-related recession, the global financial crisis, and the tech bubble in the early 2000s. And the weight of the evidence points to a low risk of global recession. There's only one indicator giving a negative signal. Also worth noting is that one indicator, global trade volumes, is actually looking less negative. So overall, a pretty decent outlook.
Alejandra, thank you for your insights. NDR clients can read Alejandra's research notes in her weekly Global Economic Focus publication. Indicators Alejandra and the research team developed for our subscription service are also used in our model portfolios, which are available for direct delivery, through TAMPs, and as ETFs. For more information on NDR, we encourage you to visit ndr.com. Also, for those listening in audio-only mode, video versions, including charts, of See the Signals are available by going to info.ndr.com/ndr-signals. Thank you for joining us as we help you to see the signals. So long.